30. Index funds, ETFs, and mutual funds. They sound like alphabet soup, don't they? Your 401n offers a dozen of them. Your advisor is pushing another. And you're left wondering, which one actually makes you richer after all the fees? The answer might shock you. In fact, many of you are currently invested in the worst option for your portfolio size and tax bracket, and it's silently draining tens of thousands of dollars from your retirement. If you stay until the end of this video, you'll learn the exact differences between index funds, ETFs, and mutual funds, not just in theory, but in the hard math of fees, taxes, and behavioral psychology. I'll show you a simple decision tree to choose the right one for your situation. You'll never wonder again if you're leaving money on the table. My name is your name, and today we're cutting through the confusion to find the real winner. Let me start with a story that will make you want to check your statements immediately. A viewer named Michelle had been investing in an actively managed mutual fund in her 401na for years. She thought she was being smart by having a professional pick stocks for her, but she never looked at the fees. That fund charged a 1.5% expense ratio, 15 times higher than a Vanguard S&P 500 index fund. On her $100,000 balance, that was $1,500 a year out of her pocket every year. Over 30 years, that one bad decision cost her over $400,000 in lost growth. Michelle could have paid for her child's college tuition with that money. Instead, it went to the fund managers. Now, the first thing we need to clarify is that confusing terminology. Asterisk index funds are not a separate category. An index fund is a type of mutual fund or ETF that aims to track a specific market index, like the S&P 500. So every ETF is a fund, and many index mutual funds are also funds. The real question is, should you buy the ETF version of an index or the mutual fund version? Or should you buy an actively managed mutual fund? This is where the confusion and the big money lives. Let's start with the biggest factor that eats away your returns: fees, the fee trap. Why 1% matters more than you think. The expense ratio is the annual fee you pay to own a fund, expressed as a percentage of your assets. It comes out of your returns, whether the fund goes up or down. In 2026, the landscape looks very different across these three types. When we talk about asterisk actively managed mutual funds, which are still the default option in many old 401n plans, the average expense ratio hovers around 1.2% to 2.0%. You might look at that number and think it's only 1%, but that only 1% is the biggest lie in finance. Let me show you the math. Imagine you're 30 years old. You invest $10,000, then add $500 a month. You earn a 7% annual return before fees. After 30 years with a 0.04% expense ratio, like a Vanguard Index ETF, you'd have around $610,000. But if you paid a 1.5% expense ratio, you'd have only $420,000. That 1.5% fee cost you $190,000. That's not a fee. That's a second house, and that's just the base expense ratio. Actively managed funds can also charge load fees, commissions you pay when you buy or sell the fund. A front-end load, often as high as 5.75%, takes money right off the top of your investment. That's like giving away your first year of growth for nothing. Some funds charge back-end loads or exit fees, and these fees don't even include the hidden cost of higher portfolio turnover, which leads to higher taxable distributions. Now, what about asterisk index mutual funds? These are passive funds that track an index, but are structured as traditional mutual funds. Think of the Vanguard 500 Index Fund Investor Shares, VFINX, or the Fidelity 500 Index Fund, FXAX. These are not ETFs. They are priced once per day after market close. And in 2026, their expense ratios have plummeted. As of May 2026, index mutual funds are available for as low as 0.01% to 0.15%, with many coming in at 0.2% to 0.04%. In fact, Vanguard claims its product lineup across all asset classes now of just 0.06%. Finally, asterisk index ETFs. Think VO, VTI, IVV, or QQQM. These are the darlings of the investing world. They are bought and sold like stocks on an exchange throughout the trading day. Their expense ratios are often even slightly lower than their mutual fund counterparts. A flagship Vanguard S&P 500 ETF, for example, charges an expense ratio of just 0.03%. Other popular ETFs are equally microscopic, but here's the dirty secret. When you trade an ETF, you often pay a brokerage commission or a bid-ask spread. These are the small transaction costs that don't show up in the expense ratio. The bid-ask spread can range from 0.01% for extremely popular ETFs like VO up to 0.5% or more for obscure ETFs. If you're a buy and hold investor making small monthly purchases, these spreads and potential commissions could eat into the small fee advantage ETFs have over index mutual funds. A 2026 analysis by the Motley Fool shows that index mutual funds can often match ETFs on fees, especially at the large brokerages like Vanguard, Fidelity, and Schwab. In fact, Fidelity's index mutual funds have been known to have zero expense ratios, completely free. That's right, you can invest in a total market index mutual fund at Fidelity with an expense ratio of 0.00%. So if the fees are essentially a rounding error between index mutual funds and ETFs, what's the real difference? That's where we get into the second major factor. Taxes. The tax advantage. When structure saves you big money. Let's consider two investors who each buy the same S&P 500 index, but one uses an ETF and the other uses a traditional mutual fund. Both hold for 20 years and then sell. Who comes out ahead after taxes? The answer is almost always the ETF investor. Why? Because of a brilliant structural innovation built into ETFs called the in-kind creation and redemption mechanism. When a mutual fund investor sells shares, the fund may have to sell underlying stocks to raise cash to pay them. Those stock sales generate capital gains that are distributed to all shareholders, even those who didn't sell. So you could be sitting on a fund for 20 years, never sell a single share, and still receive an unexpected capital gains tax bill every year. With ETFs, it's the opposite. The tax efficiency of ETFs is a major advantage, especially for those investing in taxable brokerage accounts. Major financial research confirms that, all else being equal, ETFs are more tax efficient than traditional mutual funds. ETF investors still pay capital gains taxes when they sell shares, but they gain more control over the timing of those gains, deferring taxes effectively. But what about index mutual funds? Their tax efficiency has improved significantly. Vanguard has a patented structure that allows their index mutual funds to share the tax efficiency of their ETF share classes. In fact, the Vanguard Total Stock Market Index Fund Admiral Shares carries an expense ratio of just 0.04% and is highly tax efficient. However, for the broader industry outside Vanguard, ETFs still hold the crown for tax efficiency. If you're investing inside a Roth IRA or a 401(n), however, the tax differences vanish. No capital gains taxes apply. You can hold any fund without worrying about tax efficiency. So the tax advantage of ETFs really only matters in taxable brokerage accounts. This brings us to the next differentiator: trading psychology and investor behavior. The behavioral battle. Does real-time trading hurt you? ETFs trade throughout the day just like stocks. You can watch the price tick up and down in real time on your phone. For some investors, that's a feature. They want the flexibility to pounce on a dip, but for many investors, it's a curse. The ability to check your portfolio every hour and trade instantly is a temptation to tinker, and tinkering is the enemy of long-term returns. Studies show that the average ETF holder underperforms the very ETF they own by several percentage points per year because they sell during downturns and buy during frenzies. They turn a passive investment into an active trading vehicle. Mutual funds, in contrast, are priced once per day. You place your order and you get the end-of-day net asset value, NAV. You can't day trade them. You can't watch them ping-pong during market hours. For the long-term investor, this forced disengagement is a feature, not a bug. It prevents you from making stupid emotional decisions. This might be one of the strongest arguments for using index mutual funds in your 401(k) or IRA, especially for those who struggle with market volatility. Now, let's address the elephant in the room. What about actively managed mutual funds? The ones where you pay a professional to pick stocks? In 2026, the S&P Persistence Scorecard revealed a sobering reality. Consistent outperformance by active managers is an anomaly across the board. The majority of active funds not only fail to beat their benchmark indices in any given year, but they also fail to do so consistently over rolling periods. And after fees, it's a massacre. Over 15-year periods, an astonishing 90% to 95% of large-cap active managers fail to beat the S&P 500. By any rational measure, the odds are stacked heavily against you when picking an active fund. The simpler, cheaper, more tax-efficient index funds and ETFs are the winning play for the vast majority of investors. So now you know the differences. Let's build a simple decision tree to help you pick the winner for your situation. Step 1. Are you investing inside a tax-sheltered retirement account like a 401, traditional IRA, or Roth IRA? If yes, you can ignore tax efficiency. So the choice comes down to fees and behavior. Step 2. Inside that retirement account, does your plan offer a low-cost index mutual fund with an expense ratio under 0.2%? For example, the Vanguard Total Stock Market Index Fund, VTSX, or the Fidelity S&P 500 Index Fund, FXX. If yes, that is often the superior choice for pure long-term investing. It's fire and forge it. You can't day trade it. You'll be forced to hold through downturns. Step 3. Asterisk. Are you investing in a regular taxable brokerage account and you want maximum tax efficiency? If yes, then an ETF like VTI or VUU is often the best choice. Now, what about micro-investing? If you're a beginner starting with just $20 a month, the ability to buy fractional shares is critical. Many modern brokers like Fidelity and Robinhood allow you to buy fractional shares of ETFs. Vanguard, however, allows fractional shares of their mutual funds. In this case, the mutual fund might be easier, but if your broker doesn't allow fractional ETF purchases, you could have cash sitting idle. And if you have absolutely no desire to ever log in and place a trade, a target date index mutual fund is your best bet. It rebalances for you, shifts asset allocation as you age, and costs just 0.08% to 0.15%, cheap enough to set and forget forever. Let me tell you about a real-world example of getting this decision right. My friend Jenna set up her IRA 10 years ago. She went back and forth between VTI ETF and VTSX mutual fund. She chose VTSX. Why? Because she knew she was a peaker. She would obsess over market prices. The mutual fund, which trades once a day, saved her from her own worst instincts. 10 years later, she hasn't sold a single share. She just kept buying on the first of every month. Her mutual fund balance is now over $200,000, and she never once made an emotional trade. She saved herself a fortune by choosing the wrapper that matched her psychology. Now, let me give you the final verdict. Which one makes you the most money after fees and taxes? For the ultra-wealthy with massive taxable accounts, the ETF wins on tax efficiency. For the disciplined, hands-off investor with a 401(n), the index mutual fund wins on behavioral safety and simplicity. For the beginner with a small amount of money, it barely matters. Just pick the low-cost option that keeps you investing. But here's the universal truth. Any low-cost index fund, whether ETF or mutual fund, will crush an expensive, actively managed mutual fund over 10, 20, or 30 years. The real enemy is not picking the wrong flavor of index. The real enemy is high fees and active management. Here's your action plan for today. Right after this video, log into your brokerage or 401(n) account. Look at the expense ratio of every fund you own. If any are above 0.50% or, God forbid, above 1.0%, you are losing money. Switch them to a low-cost index fund or ETF immediately. Second, if you're investing in a taxable account, check if you're holding a mutual fund that distributes large capital gains. Consider switching to an ETF if it makes tax sense. Third, set up automatic investments on a schedule. If you need the mental safety of not seeing real-time prices, choose an index mutual fund. Fourth, commit to ignoring your portfolio for the next 3 months. The less you peek, the richer you'll be. Comment below with the expense ratio of your most expensive fund. I bet it's over 0.50%. I'll reply with advice. Hit like if you're ready to stop paying unnecessary fees. Subscribe and turn on notifications. In the next video, I'm going to show you how to start investing as a teen or college student, even with $20, legally and easily. The simple path to wealth is not about finding the magic stock. It's about choosing the right wrapper for your money, controlling your behavior, and letting compound interest work. Start today. I'll see you in the next video.